The news didn't come as a complete surprise, but the reaction of financial markets was still clearly negative. In June 2013, then US Central Bank Chief Ben Bernanke officially announced that the expansive monetary policy of the Fed would be tapered off sooner or later. The first thing the Fed did was to restrict its purchase of US bonds. For the time being, however, it did not change the extremely low key lending rates, close to zero. Still, financial markets reacted as if a rise in interest rates was clearly ahead. Within a fairly short period of time, international investors sold off shares, bonds and other investments in emerging markets in order to bring back funds to their home markets. Previously, the money had moved in the opposite direction. The reason is simple. In the developed economies where there is a lot of liquidity available, it is not easy to invest money profitably considering the extremely low interest rate environment. This makes the emerging markets from Turkey over China to Indonesia attractive. Growth and interest rates were higher there, and these markets had been hardly impacted by the economic and financial crisis of the years 2007 to 2012. As long as there were massive investments flowing into these countries, the local currencies appreciated. This made them even more attractive to foreign investors. With improving economic prospects in the US and Europe, the situation is now reversed. Due to the outflow of capital, large volumes of local currency are being exchanged in US dollars and euros. This is depreciating the currencies of emerging markets on international FX markets. The most harshly affected countries are those with large foreign trade deficits. This is those countries that import a lot more than they export, because they are especially dependent on capital inflows from abroad. Precisely for this reason, the latest crisis affected countries like India and Turkey the most. In extreme cases, the outflow of foreign capital results in a situation where there is no foreign currency available to pay for imports or to service sovereign bonds issued in foreign currencies. To counter this trend, the central banks of some emerging economies raised key lending rates to make themselves more attractive to investors and to support the exchange rate of their own currency. Of course, it was not only current account deficits that were decisive for the turbulences in the emerging markets. In many cases, political upheaval and violent confrontations are the reasons why investors react. The most recent examples are Egypt, Thailand and Ukraine. A lack of political stability or a lack of legal certainty causes damage to the reputation of the respective country. Investors anticipate booms and crises in emerging markets. When investing, they follow the guidance of the economic indicators, including the current account, but also a country's reputation and current political situation. Therefore, a strategy for emerging economies is to build up sufficient foreign currency reserves during good times as a buffer. Another strategy is to ensure a sustainably good investment climate.